I had someone tell me she was withdrawing $40,000 a year from her IRA, right in line with the 4% rule. I asked her what was she actually living on after taxes. She didn't know. Turns out it was closer to $32,000. The 4% rule told her what to take out. It did not tell her what she was going to keep. A good withdrawal strategy would account for taxes. It is one of the biggest expenses in retirement. But the original 4% study, it didn't factor taxes in at all. It just measured portfolio survival. Here's the problem. The 4% rule, it looks at gross withdrawals, how much you pull from your accounts. But what is actually the amount you live on is the net. That's what's after taxes. And depending on where your money is, those two numbers can be very different. If you're pulling from a traditional IRA or 401k, every single dollar gets taxed as ordinary income. At a 20% effective rate, your $40,000 withdrawal becomes $32,000 of spending money. At 25%, it's $30,000. Now, if you have money in a Roth IRA, those withdrawals are tax-free. And if you're pulling from a taxable brokerage account, you might only pay capital gains rate or nothing at all if you're selling at a loss. Same 4% withdrawal, completely different after-tax income. The original study, it didn't account for that. It just assumed that the withdrawal amount was the spending amount. But in real life, the type of account you pull from changes how far that money goes. That's why withdrawal planning and tax planning, they have to happen together. You can't just pick a percentage and assume that it works. You have to know what you're actually keeping. Follow me for more on building withdrawal strategy that accounts for what you actually get to spend.